When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thanks so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what last week's economic reports mean for retirees and investors. We'll also answer listener questions, and then finally, how to master the 5 years before retirement. My name's Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff's radio program. It is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. How are you doing?
I'm doing fantastic. Thank you. Another great August weekend here, and excited to talk about what's happening in the market and in the economy, and more specifically, how it applies to our listeners and those people investing for retirement. Jeff, every week we're flooded with economic headlines, jobs, inflation, GDP, manufacturing. It can feel overwhelming sometimes. Instead of simply reporting the numbers, today let's answer the question that retirees really care about. What do these reports actually mean for my retirement and my investments? One of last week's biggest reports was the GDP, the gross domestic product. Why does economic growth matter so much to retirees?
Well, I don't know that it matters so much to retirees. I think part of the problem with the GDP not growing is too many retirees are saving their money instead of spending it. In addition, we're not getting actual growth with the GDP, which only came in at 1.5%, which was well below what economists expected to be over 2. It was over 2 in the first quarter. And if you really consider oil prices going up, and you consider that the producer price index for the gross domestic product jumped up to 5.7%. So even that 1.57 was just wiped out by inflation, or basically made because of inflation. So if you look at nominal GDP up a little over 5.7, you're looking at a very low real GDP growth. It's mostly just because of repricing based on the inflation numbers. So inflation's real. That's probably the biggest thing that came out of that is, why did GDP only grow at 1.5? Well, inflation's cutting into the profit lines. It's also cutting into the ability to spend money because people are having to borrow more money, especially in the investment world. We're looking at their capital expenditures are exceeding cash flows lately. They're putting so much money into these data centers, and the prices are going up, and it's driving stocks. Now we have, companies reporting earnings that look robust and great, but they're not earnings from production. They're fake earnings by screwed up accounting that is being allowed now. And that investment gains are counted as income, even though they're not actually investment gains. So if you bought a bunch of internet and semiconductor stocks in the second quarter, and we look at what drove the market, you're looking at companies that are able to report huge earnings based on their investments, not based on the fact that they actually built more chips or sold more chips. Most people didn't sell that many more chips. They sold some. The demand's higher, but most of that gain came from double and tripling the prices, or at least their margins on what they were selling, like Micron and other companies. So they're able to, look like they're making tons of profits. They're spending more in growth trying to keep up, and they're borrowing more money in order to continue to meet the demand and expand their manufacturing capabilities and capacities. And they're also able to make purchases in other companies' stock, and that shows up as earnings. So it looks like the S&P is growing at 20 or 30% earnings growth. But when you look at the real numbers, the GDP doesn't support that, not even close. It's accounting games and cooking the books in the way that things are being reported. And I don't know if that can be sustained. So I think from the standpoint of looking at the GDP and how it affects seniors is, let's go back and realize that the GDP at 1.5 does not support a robust stock market. The only thing that supports this robust stock market is gambling. People that are shooting from the hip trying to make the next big play on what stock gets bought and run up based on some Robin Hood tip or something you see on Schwab that looks good, or something Kramer says on TV. You're seeing company stocks growing, bumping at 10 and 15% in a day. It just never used to happen that way. So we're seeing a lot of weird stuff happening in the market that makes us, I think, get a little bit euphoric and maybe a little bit overconfident in the fact that the market continued to go up. But GDP is sluggish. GDP does not show that this growth is really happening. And if you look at 2 or 3 companies that are basically supplying all the gains in the GDP, and they're from the AI industry or the chip companies, which are now getting hit. If you look at some of the chip companies, they're down 20 and 30% since the end of the second quarter. So we're just looking at second quarter numbers. GDP was bad. I don't know what the earnings are going to look like in the third quarter, 3 months from now, when we start hearing the same reports. But if the stocks remain 20 and 30% down from their tops, you're going to see tons of losses and tons of disappointing earnings and probably a catalyst for the market to crash, which would equate to about October-ish, which is when a lot of the market crashes typically happen. Seriously, if we don't see the market rebound based on more hype and more buying and more forced accounting games and more forced, companies will probably buy each other's stock just to get the stock up so that they don't have to show lagging earnings in order to make up the difference. But it's problematic. It's just one more thing that makes me skeptical about the market, makes me a little bit more tentative, makes me less anxious to jump in with both feet, makes me kind of want to get off the train because it looks like it's going to be derailing if they continue to fake us out with these weird numbers and accounting games that they're playing. They didn't used to be allowed quite like this. I mentioned this earlier. Companies are able to book a sale as income, but the companies that buy that chip or buy that product can amortize it or depreciate it over 6 or 8 years, even though it's probably has a 3-year life expectancy, especially when we're talking about GPUs, microchips, and things like that. Anything in the AI industry and anything in the tech industry is being replaced at such a higher clip. I mean, when companies are depreciating over 5 to 8 years, in other words, not expensing it, then their earnings are looking a lot more robust than they really are. So, keeping that in mind, does that mean the market can't go up? No, there's a lot of people that have their wool pulled over their eyes and aren't looking at the same things I am and are just blindly going, yeah, jump in, jump in. There's a real level of complacency that scares me, and that's usually what happens before a crash. But then again, we're looking at very similar conditions that existed in the dot-com bubble back in 1997. The market didn't actually crash until 2000. So what does that mean? We started seeing people calling for the bear market, the crash in 87. They started calling that in 08. 87 was when I started. There was a crash actually back then. But in the 07 and 08 crash, people started calling foul on the bankers for misrepresenting baskets of loans, the CMOs and collateralized mortgage obligations, the things that were being sold back then. Barry's one of the guys, the guy they did the movie The Big Short on. He was calling that out in advance a year or two. So I think the similarities are happening in the market that should make people worried actually for the last couple of years. But then again, sometimes a bear market correction or crash could be pushed off for a few years based on complacency, euphoria, just the disbelief, the fact that banks and brokerage firms are willing to continue to give people margin to continue to buy stock up and to prop up the markets, even though they're not supported by GDP. They're not supported by a strong dollar. That's another thing that I'm really concerned about. It looks like the dollar's weakening in the face of rising interest rates. If you look at the 20 and 30-year bonds, the treasuries are going down in value, which means the interest rates are actually rising up to 5.25% this week. That's like a 19-year high on the 30-year just this last week. The 10-year is still around 4.7. It's still close to its 20-year high, yet the dollar's slipping. Usually when the interest rates go up, the dollar gets more favorable in value and more money comes in from overseas to buy the U.S. Treasury assets. So that's not happening. I don't know how far this can be pushed. So I think from a standpoint of a senior who's been really lucky and fortunate to be blessed by a really good and robust stock market, it's a great time to consider taking profits, consider taking some of that risk off the table based on these numbers. So again, you can't just look at GDP and say, well, it's still growing. That's good. Well, it's really not growing if you consider inflation's most of that in one or two sectors that are overly hyped and overvalued are creating the GDP. So there's really not true GDP based on consumer goods. Mostly the retail customer isn't driving it. It's hyped up industry. So taking all facts into consideration, I think it's time to be a little bit more skeptical. I'm not the doom and gloom guy. I'm the realistic guy. Honestly, I'm a little jumpy with the market right now. Every time it looks like it's going to sell off, it could be the next big catalyst to make it go. Does that mean we're not in the market? No, we're still in the game. We're still trying to hit the ball. We're getting some hits and we're missing some pitches. But, a game's a long game. You don't have to win every inning. You don't have to win every at-bat. We just have to keep on looking at ways to make money. And when the market goes up, we jump in. When the market looks like it's falling apart, we're going to throw in the towel. We're going to take a break. We're getting kind of to that point where these things are all looking like risk ought to be taken more seriously now than it has probably in the last couple of years. It wasn't really taken that seriously in 2022. It should have been because inflation got way out of whack. Inflation's starting to get way out of whack again. And we saw what happened to the market, a 25% correction back then. Then we've seen some government manipulation with the market with printing money, a lot of hype, the AI hype. Every time there's a hype, it creates a big bubble. Bubbles eventually pop. And that's kind of where we are right now. So I think caution is probably more the idea of the day. be ever really growing more cautious of the market if you have a big amount at risk. Now, fortunately, the people that have dealt with us for a while and do comprehensive planning like we do have a lot of principal protected accounts that if the market continues to fake us out and continue to grow, we still make money, or we still at least don't lose. And typically our average client has about 2/3 of protected assets that are generating income or protected for rainy day expenses or protected from the next market crash. And then we make the money on the amount that somebody feels comfortable risking. Now, of course, I said on average, we have some clients that are all in the market because they have big pensions and great income. They don't have to worry about it. But most people have saved money for retirement because they want to be able to live on it for the long haul. If we have another 50 or 80% correction like we did in the NASDAQ, people are going to have a hard time making ends meet with their savings and with their market investments, especially if they've started increasing their lifestyle based on the fact that the market's been doing so well over the last few years. So you never get hurt taking profits. You never get hurt with principal protected accounts. And you'll even find that with principal protected accounts that generate income, you'll find out that you can safely and even on a guaranteed basis take out more income than you can using the Wall Street model, even though you have 20% years every now and then, because the Wall Street model also has down 10s and down 20s and a few corrections along the way. And over a 3 or 4 decade retirement, you're going to have corrections. You're going to have even market crashes, and those will devastate you if you've got everything at risk, even though it was the risk accounts that got you to retirement. It is not the risk accounts that get you through retirement. So keep that in mind and also take that into consideration when you look at GDP and all these stats that are coming out lately.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the market and the economy, the reports that came out last week. Our phone number, 520-780-9059. Every week the headlines change. One week it's inflation. The next week it's jobs. It's the interest rates or the stock market, trying to make retirement decisions based on the latest news cycle. It can be exhausting and it can be expensive if you get it wrong. So if you'd like a personalized retirement strategy built to weather the changing economic conditions, right now is a great time to sit down with Jeff and the team here at Premier Retirement Planning and talk about your retirement goals and how to get there. It's not going to cost you anything, totally complimentary. Jeff will help you understand where you stand today, identify potential risks, and develop a written retirement income plan designed for your goals and not the latest headlines. Once again, the number, 520-780-9059. You can make the call right now if you want. Leave your name and number. Shelley will return the call during the week and set up that appointment for you. Again, it's just a casual conversation with no cost and no obligation. It's 520-780-9059. You can also find out more about our firm online at premret.com, PREMRET.com. Jeff, let's get back to our conversation talking about the market and the economy. Turns out that Kevin Warsh made some comments last week for the first time. What is your take on what he talked about there insofar as reducing rates, keeping them the same, or I understand there are even some whispers of raising rates?
Well, it wasn't just whispers. 3 of the people on the board, the regional presidents, dissented in favor of a hike right now because of inflation. They ended up keeping the Fed funds rate around 3.5 to 3.75 this week, but it wasn't a clean decision. When you have dissenters, not everybody's focused on the same thing. Some people just want to be puppets for Trump or whoever's in charge or make the economy look better. But one of the things Kevin Warsh said, and I appreciate it, is, hey, there is no soft, it's okay if we're around 3% inflation, or, it's okay if it's 2.9. The mandate was 2.0, and he said there is no soft alternative 2.0. That is the mandate. 2.0 is the inflation target, period. And it hasn't been down there for almost 4 years now. So it hasn't even looked like it's close. It's been in the 2 somethings, and somehow we're getting complacent and okay with that. Then when it pops up to 3.5 or 3.4, like it just did in December, or it was actually 3 in December, it's up to 3.4 now. So it's gone actually up. I was looking at my notes wrong, but I don't see it going down towards 2. It looks like it's climbing definitely the wrong way. Now, oil is a big part of that, definitely. Trump's trying to get that under control by winning this war and getting Iran to come to a table on its knees and give up what they want. But who knows? I mean, they're built to die fighting, not to come to any deal. So who knows if that's going to happen? So oil may be the problem for a long time. That goes into everything with transportation, costs of not just hauling goods to stores and getting them to the consumer, travel, different things like that, just creates inflationary pressures that we don't really want. So in order to get that under control, we either have to increase supply, which we haven't really been doing. We haven't seen, even though tariffs and things like that, we're supposed to bring a lot of manufacturing and commitments over to the U.S. That's going to take a while. Some are working on it, but some are backing off based on the fact that court decisions have kind of made it look like those tariffs are not going to be enforceable. Some people are saying, okay, then neither is our deal. So we don't know if we're going to get the supply chain fixed or if there's going to still be a supply issue. And if there is, then inflation is going to still be a problem. So we've got a lot of things to look at and a lot of things to overcome here inflation-wise. Warsh knows that. He's being a realist. I think he's at least being honest. I think he wants to look like a guy who's immovable and basically doing his job without regard to what the president or anybody else wants, but what the economy needs. So I think his heart is in the right place. I think his experience is, I don't know, seems like he knows what he's talking about. It seems a little bit more decisive than Powell, especially in the way he communicates things, in my opinion. But I think the bias is going to be raising interest rates unless we can get this war done. Oil prices come way down and we can see inflation fall just based on that. But I don't think it will without continuing propping up the interest rates, unfortunately. And there's good things and bad things. I mean, the problem is it hurts GDP because people can't afford to borrow money to buy things and are less willing to buy things, especially discretionary items, not to mention the tech industry that's highly dependent on debt. You've got some tech companies whose debt service is beating their positive cash flows. Yeah, it's kind of like the U.S. I mean, you look at AI companies that are going to have to generate trillions of dollars in revenues just to get out of the debt that they're in. And they continue to basically dig in a big old sinkhole where AI was supposed to be and ChatGPT was supposed to be free and public domain. It can't be. They're going to have to start charging for it. It's going to become another costly item that'll probably create more inflation in a certain sense. So again, how do you combat that? Interest rate changes are one way. Supply is another. Supply doesn't seem to be happening, and interest rates might be the way that they curb it. The problem is that makes servicing our national debt a lot harder. It may be pushing us toward what Ray Dalio's talking about is the big old credit reset, the credit cycle blowing up like it has in other countries and other civilizations like the Roman Empire when it finally ran out, when it took all the money from its citizens and then the citizens had no more ability to supply the demand that the government fell. And I think that's kind of, unfortunately, a very sad similarity that we're looking at is, all this debt that we've created, there's going to become a day of reckoning. And my heart is with Kevin Warsh. Good luck to him. He's got one of the hardest jobs in the world right now because the pressure is to get the economy rolling by lower interest rates, which would help service debt, but it would just create more inflationary pressures based on what's happened the last 15 years or so.
Jeff, let's bring this conversation home about these economic reports that we heard about last week. They help us understand the environment, but should they completely change a sound retirement strategy if you already have one?
Well, I mean, that's a good point. I think the clients that have dealt with us for a while, not brand new clients that just come in and are trying to figure it out, don't really know how good it will be until the market gets really squirmy and gets really risky and they start worrying about their money. If you have a good comprehensive plan that generates all the income you need on a guaranteed basis and a lot of income that is also very tax efficient that you can use on a predictable and kind of on a discretionary basis, then you don't have a lot of pressure with the money that you have at risk in the market. When the market's good, you take advantage. And when the market's bad, you don't lose. You're still paying your bills. So, if you've got a good plan that can weather these storms, great. Now, some people think that plan's boring when all their friends are making a ton of money in the stock market, when NVIDIA is doubling its price on a year-to-year basis. And Micron goes from 300 to 1200. By the way, it's back down to the 800s now. But it's still, you've got all these upsides. By the way, we do have positions in those companies when they go up, and we typically sell when they start reversing. So we make money in the markets during those times on the invested money. But some people are so enamored by the growth cycle of the market and feel like they're missing out. They have to be in it, but they're typically not our customers because we don't like that. I don't like to lose sleep over my clients' money. I like to make sure that I know that they're getting a paycheck every month to pay their bills until they die. That's why we set up long-term plans, not just, hey, this is a bucket for the next 5 years. We'll watch this and keep it safe and you can spend this. And in 5 years, this bucket of money is in growth stock, so it should be higher. Well, the stock market in 2008 crashed and 2002 as well, crashed more than 50%. And it took more than 7 years just to get back to a break-even point. If you were in tech stocks in the 2000 crash and the dot-com bubble, it took 14 years for that to come back. So just because you have this 5 or a 10-year bucket that you can supposedly use and it's supposed to grow to a point to make up the difference on what you spend in bucket one for the first 5 years, doesn't mean you'll actually have money. If you do that, you could be very sorely disappointed that you only have half the money to spend in 5 years than you thought you would or that you had planned, because there's no guarantees. It's just hold and hope the market produces results over those periods of time. I'll tell you, in the next 5 years, I expect there will be a crash. I said that probably 2 or 3 years ago, so it's probably closer to the 2 year or less mark is probably more realistic. It's just unbelievable that it can be sustained this long, but we're seeing the cycles of, the euphoria, the Me Too's, the FOMOs, the fear of missing out, but we're seeing just kind of the overhype of a new market. And again, every time a new tech product hits, and Jamie Dimon said this too, I'm actually repeating what people smarter than I am are saying. Warren Buffett's same thing. He's got 40% in cash because he's just not willing to pay the prices for stocks at the current levels as other Americans are. He's just not willing to do that. Banks are hoarding cash now. It looks like they're doing a lot less spending, selling some of their positions, but all the while telling you to buy so they can sell. The market works against us typically, but smart people are saying be cautious more now than ever. We're getting through that cycle, and there will come a top of that cycle, and it will go down again. I mean, that's just what cycles do. So like I'm saying, I'm not being doom and gloom. I'm just explaining what history shows us the market does, and it always does that. If this time is different, it might be different in the way it looks, but it's going to end the same. I just don't know when. The market does. But in the face of all this information, sometimes it's distracting information. Sometimes it looks like it's supporting the market. These fake earnings that we're seeing look like they're supporting the current market and draws people in. But yeah, if you've got a good plan, make money when the market's good. Don't lose money when the market's bad, or at least minimize your losses. And you can do that by just setting up a plan that you can feel comfortable with. And if you're trying to get rich during retirement, typically the market dragon will rear its ugly head and you'll get burned. So be careful going into retirement with the same ideas that got you there, because when you're making a paycheck and you can invest all your money and wait the market cycles out, it's a whole different story than if you're spending money out of those assets. You can't wait the cycles out. You're actually using that money. So we like principal protected assets. We like assets that generate tax efficient or even tax-free income, Roth IRAs, LERPs, those things. We also like fixed index annuities that don't have any risk on the downside, where companies know that they're not going to lose money because they're not investing your money in the market, and they know that they can guarantee you a higher lifetime income than you would get from the typical 3 or 4% rules in the stock market. So if you have a plan, you should be comfortable and not worry about all this stuff. It's just noise, and it's just interesting stuff. It might give you an idea of where the direction goes or when the next market correction might be, or, when we're getting close to interest rate hikes or decreases, when it might be a better time to buy a house if you're thinking about doing that, or a car, things like that. But honestly, if you've got a good plan that generates income, that saves your taxes, that protects you if you ever need a nursing home, that protects you in market corrections, that helps you keep more of your money and send less to the IRS and give your heirs the biggest tax-free and efficient, probate-free retirement legacy, then we're the right place. And you've got a plan that does that, then don't worry about all this noise. Just take it as news, but not anything that's life-changing or causing you to have to make moves. We watch the markets too. When there's times to make moves or make upgrades or changes to your portfolios or plans, we know when to do it. We're doing similar plans with hundreds of people. We've done plans for thousands of people over the years, and currently juggling portfolios and plans for many people, just like the people listening right now. But we don't have a lot of people calling us when the market's correct, because they know they're getting a paycheck every month and they've got a plan that works.
Good conversation, Jeff. I want to chime in and remind people that if listeners remember one thing from today's conversation, I think it should be that the economy is always changing. Inflation changes, interest rates change, markets change, government policy changes, and that's why successful retirees don't build plans around today's headlines. They build plans designed to work through good economies, bad economies, bull markets, bear markets, and pretty much everything in between. That is real retirement planning. So if you want real retirement planning, you're listening to the program today, you like what Jeff has talked about, and you realize that he really does dig into the headlines and certainly takes all of this into consideration, call us at 520-780-9059 and request your Premier Retirement Roadmap at no cost and no obligation. 520-780-9059 is the number. You can make that call right now if you want. Leave your name and number. Shelley will call you back during the week and set up that conversation for you. Absolutely no cost and no obligation. You can also find out more about us online at premret.com. That is PREMRET.com. Jeff, time for a break. We come back here on Premier Retirement. We'll answer listener questions, then later on, how to master the last 5 years before retirement, when our show continues here on 790 KNST Tucson's most stimulating talk.
If you're a high-income earner, you've probably heard about the Roth IRA, tax-free growth, tax-free income in retirement, and a powerful way to pass money to your family tax-free. But there's one big problem. Most high-income families don't qualify to contribute directly, and that's where a strategy called the Backdoor Roth IRA comes in. At Premier Retirement Planning and Wealth Management, we help successful professionals and retirees understand how this works, and more importantly, how to avoid costly mistakes. Here's the example. You make a non-deductible contribution to a traditional IRA, then you convert it to a Roth IRA. Often you should do this right away, but there's one major rule most people don't understand. It's called the pro-rata rule. And if you already have other IRA money, it can create an unexpected tax bill. So before you do anything, get professional guidance. You can call us at 520-780-9059. We'll help you evaluate whether a backdoor Roth strategy makes sense for you and how to avoid those mistakes. Call 520-780-9059 or visit us at premret.com. Premier Retirement Planning and Wealth Management, where smart retirement planning begins.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
We really appreciate you making us part of your weekend. You're listening to Premier Retirement with Jeff Vogan. I'm Jeff Shade. We're here for you each and every Saturday and Sunday for your fiscal fitness and financial education here on 790 KNST, Tucson's most stimulating talk. We're on the air for you Saturdays, 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. And if that's not enough, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement. You will find this show and all of Jeff's past shows so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. Hear anything that piques your interest? You'd like to come in and sit down, have a casual conversation with Jeff. No cost, no obligation. You can set that up by calling 520-780-9059. All right, Jeff, time for listener questions. Richard is listening to us in Dove Mountain. And Richard says, I'm 55 and left my previous employer, leaving my old 401k in place. I know the IRS rule of 55 may let me withdraw from it without the 10% penalty. I've since started a new job with a new 401k. Can I still take penalty-free withdrawals from my old employer's 401k? And if I later leave my new job before age 59 and a half, can I use the rule of 55 for both 401ks?
Well, that's an easy, quick answer. You gave me enough information for just that. I might give you some additional suggestions, but yes, you can. Once you've left the other employee, there's no restrictions on that 401k. There would be on your new one, most likely. They're probably not going to let you take money out while you're putting money in, but once you leave that job, as long as you're over 55, you can take that out without the 10% penalty. Keep in mind, you'll pay taxes on it. And I don't know if you're going to get, new jobs or whatever. And if you weren't 55, for those listening that might be a little bit younger than that, you can actually generally take loans against your 401k that are not taxable, and you can kind of wait till you're 55 and then either just call it a distribution and pay taxes at that point and have the balance adjusted on that account, or continue to take withdrawals until it's gone. And at that point, whatever loan you took out would be taxable. The cool thing about loans is that they're not taxable when you pull them out. So if you are working, and I don't know if your new employer doesn't pay you as much, and that's why you're considering taking some of your money out as withdrawals, but consider the options for what your 401k might let you do. If you needed it to buy a new place because you have to move for the new job or something like that, and you needed some withdrawals, you might even want to take that loan out if you're still in a high income, so you don't get in a higher income bracket. Maybe when you're 59 and a half or 60, you quit working. Maybe you've got a few years that you can do either some Roth conversions, or you can take out more of that money or pay off that loan, pay the taxes at that time while you're in a lower tax bracket. Again, there's a lot of different nuances of what you're doing and why you're doing it, and what the other conditions are of your financial situation, where I would ask you a lot more questions than, hey, can you use it? You might already think of what you're going to do, and you might be comfortable with the results, but you might not know 100 other options that are available to you, or how you might make those withdrawals more tax efficient, or why it might make more sense not to take any money out of your 401k until you're 60 or totally retired, because you still have some tax deferred growth and you're making enough money to live on in your new job. So you might keep that new job for a while. The other thing you might want to consider is, instead of contributing to a new 401k, if you want some penalty-free withdrawals and you want some principal protection, you might want to consider supplementing the old 401k. I don't know how much is in there. Maybe you have $1 million in there and you don't really need the new 401k for too much, but maybe you've got $50,000 a year you could save, and 20 of it's going into the 401k and the other you don't know what to do with. Well, take the match. If they match 3%, put 3%, you have to take the match on the 401k, whatever it is. But the extra money you might want to consider, based on your tax situation, is to put it in something that's tax-free, not in just a Roth portion of your 401k, but even consider a LIRP, life insurance retirement plan, that grows tax-free. You can get added at any time with no penalty, not like the 401ks or IRAs that have a penalty. And the other thing is If you think taxes are going to go up in the future like I do, you're going to be able to take money out of that account tax-free via loans. Kind of like I told you, loans off of 401k aren't taxable until you decide to make them taxable. The loans off of a LRP are not taxable, and when you die, they stay non-taxable because a death benefit is tax-free. The death benefit on a life insurance policy pays off all your loans that you use during your life. In other words, you get to spend your death benefit. Let's say you pay a couple $100,000 for $1 million death benefit, but you get to spend the whole $1 million before you die. Wouldn't that be nice? You don't have to die to get it. You get to use it, and then when you die, that $1 million pays off the loan or pays off what you've already spent on living. So you can diversify from the 401ks into Roths, into LRPs. You could even consider moving some of that 401k money into something if you decide not to touch it until you're 59 and a half into an IRA that is principal protected, locks in all the gains that you've made on that old IRA instead of subject them to a potential market correction, which might mean you can't retire at age 59 and a half or 60 like you thought. If the market's down half and you've lost half of your $1 million 401k or $5 million 401k or $500,000 401k, whatever it is, you could lock that in and be guaranteed a certain income. $1 million in a 401k that's at age 55, if you let it sit for 10 years, you're going to be looking at somewhere in the neighborhood of $100,000 a year in income or more by the time you retire. Guaranteed. No, you can't do that with a pension, most likely. And the stock market ups and downs might not allow you to take that much out of an investment portfolio either. So you might take the old 401k, set up a lifetime income for the next 5 or 10 years that you'll take in the next 5 or 10 years when you're done working, and then dollar cost average, just go full bore into the stock market and aggressive investments with new money so that if the market crashes, it's on less. And if you're continuing to put new money into it, if the market crashes, that's great because then you get to buy all your contributions into your 401k are basically buying the stock on sale so that in 5 or 10 years, it'll be worth even more than the average rate of return on the index or the market. Meantime, you don't have to lose money on the big chunk that you've saved between the time you first started working and 55, which is, I guess, right now.
Richard, thanks for listening to us in Dove Mountain. And again, if you want to further the conversation with Jeff, our phone number 520-780-9059. You can call this weekend if you want. Leave your name and number, and Shelley will call you back and set up that appointment. Okay, Jeff, next question is William in Catalina Foothills. And William says, Jeff, I'm rebalancing my portfolio as I head into retirement. My target is 65% stocks and 35% bonds. But part of my portfolio is in a dividend fund. Should I count that dividend fund as part of my stock allocation or my bond allocation?
Definitely stocks, even though bonds can lose money as well. If they're dividend stocks, they are still stocks. They still have risk. One of my favorite examples, and people are just always, well, yeah, but I've got AT&T. It's always paid a really good dividend. Well, let me just pull it up here really quick. Year to date, AT&T is down 4.7%. And on an annual basis, it pays a 4.7% yield. So people think, well, that's great. Well, what is that great dividend stock done in a year? Well, it's actually down 15%. Over 2 years, it's up 23. Over the last 10 years, it's actually down 28%. So you're losing on average 2.8% a year if you look at simple numbers while you're making 4.7. So keep that in mind. Dividend stocks don't always make sense because they still go up and down. And I just use that as an example. I just had somebody say, well, yeah, I've had AT&T forever. They pay a great dividend. But if you lose money every year, it doesn't matter. I just saw there's this one person that writes about the best retirement returns. Just this morning, it was a fund. It was a dividend fund that pays 14% dividends. That sounds phenomenal, doesn't it? Well, over the last 2 years, it's lost 44%. And it's down 24 year to date. So 44% down in 2 years, but it pays a 14% dividend. I mean, how in the world is that sustainable? If you have, let's say 30% of your money and stuff like that. And, let's say you have $1 million, 30% is that there's 300,000 down 40%. I mean, you only got $180,000 left. And what did you collect it in dividends? Well, it's 14% based on today's value. Let's say it averaged 3. So over the last 2 years, you've made about $16,000 or $18,000, but you've lost 180 or 120. Doesn't make a whole lot of sense. It's definitely a stock. They definitely have risk. You have to treat them like that. And just because they pay a dividend doesn't mean you could just buy and hold them forever. There are some stocks that are supposedly dividend stocks that if you've held them for 40 years, you've probably done okay. Like the ones that pay 2 or 3%, like Kimberly-Clark or IBM or Chevron or whatever. And what's a 2 or 3% dividend? The stock still goes up and down. I think it's still a stock. You just get lucky to have a dividend. And I think dividend stocks I like dividend stocks, and there are times when dividend stocks are in favor because maybe the market cycles are kind of weird. We just saw that in the recent month or two while the AI and the semiconductor sell-off, our income portfolio did pretty good because people were jumping into income-producing stocks and bond-type stuff. So now that that sector is getting hotter, it's a little bit harder to make money on the price of the dividend stocks because people are more enamored by the growth and fear of missing out of another bull market in the semiconductor industry or the AI data center market. So again, you have to take that with a grain of salt. But I think if you're going to do bonds, do laddered bonds. Bonds are very out of favor, in my opinion. Now, there are people going to bonds just because they're at least a safe place, and rich people do go to bonds as a safe haven. A lot of people are parking their money in short-term bonds, kind of like money market. But the long-term bond market, unless you're just really okay with making 4 or 5% for the next 30 years until maturity, which, if you got billions of dollars, you probably got a big chunk that you want to have in that kind of an allocation. But if you've only got a few $100,000 or $1 million or $2 million for retirement savings, the price of those bonds, if you ever need to sell those bonds and you can't hold them to maturity, there's a big possibility you could lose money. Now, if interest rates start going down again, and they probably eventually will, you might be happy to buy some bonds now because in a few years they might have gone up and you might actually have some appreciation. So I always look at the full picture. It's not just what interest rate they pay, it's what the potential total gain is and what the potential harm is if you need that money either in the near future, if it's part of your income plan, or if it's just part of your legacy plan where you're just going to park it and hold it for the long term, but you want some safe money that you can bet on in the future at a certain period of time in your future.
William, thanks for listening to us in Catalina Foothills. Once again, the number 520-780-9059 if you'd like to further this conversation with Jeff. No cost and no obligation. All right, Jeff, Barbara's in Green Valley, and Barbara says, I'm an avid listener of your show for a few years now, and I just love it and your clear and concise way of explaining some of the most complex subjects. Thank you very much, Barbara. Can you educate us and me on what you mean by investing in quote-unquote treasuries? This category of investment sounds like it's safe while providing some growth. I also hear that sometimes the very wealthy invest in this. So what exactly is meant by treasuries?
Treasury is basically government securities. It's basically government bonds. The Treasury offers them. The Treasury balances its budget by them. They issue them to create the money supply. They buy bonds and create and put dollars into the system, usually through the major banks. They do that. And then the banks have money either to loan or to create economic benefit. But they can also sell them to very wealthy people, big family banks, big institutions, and they put their money in them because in the scheme of things, if there's a 2 or 3% inflation rate and they can get for the next 30 years a 4 or 5% on billions of dollars, it gives rich people stability on some of their money. It's also interesting that the billionaires, so the super wealthy people that like treasuries, if the stock market averages more rate of return over time and they can afford to take risk, why aren't they just all in the stock market? It's interesting because maybe they don't want to invest in the stock market. Maybe they don't like all risk. Maybe they don't like their portfolio and their net worth going up by billions every year or hundreds of millions of dollars every year or down. And they like the stability of what bond can create. Bond ladders can create them. In fact, a bond ladder is not a bad thing to do in retirement if you like the idea that bonds might produce a reasonable rate of return. Now, the other thing is you can buy bond ladders through index annuities and LERPs. That's what the insurance companies actually invest your money in. Treasuries mostly, or investment grade bonds, similar to treasuries, similar in safety. I mean, usually A-rated or at least investment grade or better. And typically all of their bonds are, and they ladder them so that they know what interest rate they're going to make. And the cool thing is an insurance company has what we call economies of scale, where they can take the 4 or 5%. If you invest in a bond ladder that averages 4%, the insurance company can invest in that same bond ladder, average 4%, take one off the top, but they can use the 3% that's left and invest it in options that they can, on average, maybe double or triple that interest rate, which makes them potentially better off and you potentially better off. The thing is they will also guarantee that even if the bond values go down because interest rates continue to go up, they take the risk out of your hands. So there are ways to play the bond market and do treasuries by using companies that have already amassed a huge fortune in treasuries. You could also go on into some bond funds that are managed by hedge fund managers like Jeff Gundlach, one of the biggest bond traders ever. PIMCO, Bill Gross of PIMCO was a guy, I don't know if he's still back in the business or not. I think he actually is, but there's some great bond traders you can just ride the heels of if you want to let them take the risk and you like bonds. The problem with bonds is they always generate interest. And if they're not in an IRA, you continue to have to pay tax on that interest generated regardless of whether you use the money or not. So again, if it's an IRA, it doesn't really matter. Income is income and it's taxable no matter what. But that gives you kind of maybe a little bit overview, broad stroke of what treasuries are and why people use them, why rich people use them, why even non-rich people use them. I think, if you're scared of the word annuity, bonds on a laddered basis might be an alternative to put some safety or at least predictability into your portfolio with treasuries, where even though you could make more maybe other ways, or at least have potentially a better return with no risk, bonds are an alternative that are available in the Wall Street model, basically stocks and bonds and cash are about the only thing they offer, is as an alternative to, levelizing the returns or kind of minimizing the volatility in your retirement plan.
Barbara, good question. Thanks for listening to us in Green Valley. And again, if you'd like to further the conversation with Jeff, 520-780-9059 is the number, 520-780-9059. If you've got a question you'd like us to answer on the air, you can get it to us by calling it in to 520-780-9059. Shelley will take it down for you, or you can go to our website, pro-rata.com, and use the contact page there. And we would love to hear from you and answer your question. If retirement is 5 years away, or even if you're already retired, right now is the time to make sure that every piece of your financial life is working together. Don't leave one of the biggest transitions of your life to chance. Call Jeff Vogan and the team here at Premier Retirement today at 520-780-9059 to schedule your complimentary retirement strategy session. That's 520-780-9059. This one conversation really could make a lasting difference in your retirement tomorrow. Jeff, we spend decades saving for retirement, but you often say the last 5 years before retirement are the most important years financially. Why is that?
Well, we call them the critical years. Actually, the last 5 years before retirement and the first 5 years into retirement are when any mistake could be amplified greatly over the next 30 years. I tell the story about Norm all the time, and I use the kind of a symbolic story about Mount Everest. There's actually a movie about it now. It's kind of an industry standard example. Getting to retirement is kind of like climbing a big mountain. Let's use Mount Everest. And when you get to the top, people think, okay, it's easy to get down. Well, almost everybody who dies on Mount Everest dies on the top 3,000 feet of the 29,000-foot mountain. They call it the death zone. That's where most people die. And interestingly, more people actually die on the way down in the death zone than on the way up. They get up there, they think it's going to be easy, they let down their guard, and they just cruise. Sometimes people get to retirement, they get through the last 5 years, they get to the top, they go, yay, hi, I plant my retirement flag, it's just downhill from here. The market crashes, they can't go back and get their job, they lose half their money. And I've told the story about Norm, who was an engineer up at a big chip factory up in Phoenix. I probably said the name before, but refrain now. But a big company that's still in business, doing great work, and he worked on some really important projects, making $100,000 a year in the 90s, which was huge money compared to now. It was probably $300,000 or $400,000 a year. Had a very huge 401k based on the time. Back in the 90s, not very many people made it to $1 million in 401ks. Now it's pretty commonplace. If you don't have $1 million in a 401k, it's probably hard to make ends meet unless you have some pensions or you've got no debt and you're willing to live responsibly or frugally, let's say. But he had plenty of money to retire if he didn't lose it. And his advisor, which was through their 401k company, they always came and visited and wanted to carry on their accounts after retirement, which this guy did by talking Norm into continuing to let his money ride in the stock market. Well, he retired in 2000. Stock market, the dot-com bubble bursted, and he lost 80% of his money while he's only 60 years old, having to spend it because he can't get on Social Security, and he didn't really have a choice. He took Social Security early, which wasn't in his original plan. He had to get a job, which wasn't in his original plan, all the while, his spending habits were about $80,000 spendable per year. And while the market's going down from $1 million to $250,000, which is where he told me it bottomed out, could have been worse. I mean, if you look at the NASDAQ itself, it went down over 80%. He was actually able to spend a little bit of money and it still bottomed out at 250. So in my opinion, he had actually luckier than some. And then it started coming back. And his broker says, see, it always comes back. It always comes back. Norman's coming back. And he's thinking, well, wait a minute. I'm spending half of what I was spending because now I'm on Social Security and I have a job. And I met him almost 10 years later. And, the market had gotten a little bit better while he worked. But he still wanted to retire. 10 years after his real retirement, he's still working part-time and he's still locked into a low Social Security paycheck, which means he continues to have to take money out of his investments. Then in 2007 and 8, market crashed. 2009, he came and saw me and said, hey, Jeff, can you fix this? I heard you're a smart guy. And I said, no, I can't. You died on the mountain, Mount Everest. You climbed it, you planted your flag, but you didn't take profits off the table. You didn't take a minute to look and realize that getting off the mountain is a whole different strategy than getting up the mountain. And that's why people die. They let their guard down. They think that the same thing that got them up the mountain is going to be what gets them off the mountain. You can even think of it, extending this analogy to just what muscle groups. It's all quads and glutes, right? But getting down, man, it's all on your knees and it's different muscle groups. You feel different, right? And if you fall going downhill, let's say you fall going down the stairs, you're going to do a lot more damage most likely than if you fall going up the stairs. You just skin your knee. Going down the stairs, you might break a bone or break a neck, heaven forbid. So again, the last 5 years before retirement are important, but I wouldn't say they're as important as the first 5 years into retirement. The thing is if you already get to retirement like Norm did right before the market crashes, you don't even have to get to the 5th year in retirement. He's in his first retirement year and he can't go backwards. He should have done something the prior 5 years. And that's why they're most important. It's the greatest time to plan because you can set yourself up so that you know that you're going to retire on your terms, that you're not going to risk your livelihood, that you're going to get a paycheck every day for the rest of your life that's going to support you based on your terms of retirement. And you're only going to risk the amount that you can afford to lose or that you can afford to have crash in the next market crash that you're not expecting, especially when the news is playing it off like it's never going to happen. It's a do market. It's never going to be the same. .coms forever. But it wasn't. And all of a sudden it crashed so fast, people didn't even see it coming. I think some people saw it coming, but nobody would believe it. I think right now people are seeing the crash coming, but most people who are investing aren't believing it. The thing is the smart money is believing it and they're going to cash right now. So maybe we ought to follow suit. Maybe we ought to be a little bit more cautious. We certainly are more cautious, but we've already been cautious before all this happened. We've moved tons of retirement money over to principal protected assets that aren't going to take a hit when the market goes down, and they're already supporting our clients, our client family, with their income needs on a year-to-year basis so they can wake up at least knowing that they're going to be okay. So again, 5 years before retirement is a great time to make sure your plan's in order, make sure you set up incomes that if you already know your retirement date, you can pull the trigger on that date and know you're going to be okay no matter where the market is between now and then or where the market goes for the next 30 years.
Jeff, you're sort of like the Sherpa of retirement planning. You help people get to the top of the mountain, and then you help them on the descent to the other side. If someone is listening right now, within 5 years of making that journey, or they're right at the peak right now, what should they be doing, or what should they really be looking at to make sure that they can get down the mountain as well as getting up?
Well, when they're getting up the mountain, they have a job, so they've got a paycheck. The first thing is to make sure that your income in retirement is secure, that it's more than just an estimate or a guesstimate. It's more than just related to something you can't control, like a stock market return. It should be either guaranteed or at least predictable to the point where you have enough flexibility and enough buffer in it to where you're never going to starve on a month-to-month basis or even a year-to-year basis, and have enough money in emergency funds to fix the air conditioner or go on that trip or help your kid out of a jam or whatever you need to do without putting yourself in a new tax bracket or having to liquidate assets at a loss and that kind of thing that so many people have to do when they've got everything sitting at risk in the Wall Street model. Now, I'm not dogging on the Wall Street model. It gets people to retirement. We still use it for a big portion of our clients' retirement funds. We've been really good at managing money and beating market indexes, but we don't expect to do that forever, every year, every minute. And we don't expect the market to always play into our strategy. But we do know that if you have secured enough of your income that you don't have to worry about a whole lot. So really it's just, okay, how am I going to replace my paycheck, Social Security, pensions? How much of my retirement plan do I need to invest in those income producing assets? Now, what do I do? How much risk can I tolerate? Have I done anything? Because, one of the biggest events after retirement before you die is, what if I need some long-term care or assisted living? I have a client, unfortunately, just called me yesterday. She's moving to her third assisted living facility. It's escalating into more and more care. And bless her heart, she's saved a long time. She's got a condition that she kind of knew she'd end up there, but she didn't when she retired. But thankfully, she didn't live high on the hog and blow all that money, so that she has enough money to buffer her Social Security and other incomes, that she has at least a few more years of time, which is about her life expectancy, in savings that she's put away and already planned for. So we already set up for the rainy day. So now that the rainy day's here, it's there for her use and she has the peace of mind. And I always get to reassure her that she's not going to run out of money, that she has the income that she needs, and she's got the plan to cover her long-term care, just like we talked about years ago. So that's what we hope to accomplish in that final retirement plan. Also, do you want to leave a legacy? Do you want to spend every last dime? And by the way, I believe taxes are going up. How can you create over the next few years a structure or plan a structure that when you retire, we can quickly move to a more tax efficient retirement plan? It might not be right now while you're working, but it might start the day you quit into do Roth conversions, LRP conversions with IRA assets. Pay the taxes now on less money instead of paying taxes at a higher bracket later on more money. It makes sense to pay at a lower bracket, and it also makes sense to pay on less money. So tax planning is a big part of that. And then make sure that if you want to leave a legacy, make sure you have a trust, an estate plan if you need it, beneficiaries designed to make sure that your assets pass to who you want, how you want, and when you want.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about the last 5 years before retirement, at retirement, and the first 5 years into retirement. We call this the retirement red zone. If you're in that circumstance right now, you're not sure whether or not your retirement plan is built to last the test of time, you'd like a second opinion on that, call Jeff here at Premier Retirement to discuss it. 520-780-9059 is the number. It's 520-780-9059. No cost, no obligation for a second set of eyes on your retirement plan. All you'll do is call that number, leave your name and telephone number with Shelley. She'll call you back during the week and find a convenient time for you and Jeff to chat. Again, no cost, no obligation, no judgment, 520-780-9059. We're also online at primret.com. Well, Jeff, we just get started and we run out of time. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. Thank you so much for joining us here. Be sure to join us again next week for another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.